Hi, welcome back. Now that we've reached the end of the third quarter 2023, it's time to take stock of what this year has brought for us, both in terms of the economy and in terms of markets. We started the year with a significant amount of uncertainty about two issues. One was what would happen to inflation, and the consensus view was it would be a struggle to bring inflation down. And the other was what would happen to the economy. And there, the consensus view at the start of the year was we're headed for a recession. Nobody knew how deep, but people were pretty certain that there was going to be a recession. In the first half of this year, the market delivered surprises, and so did the economy. Inflation came down sooner than most people thought it would, and the economy proved to be surprisingly robust, resilient in terms of employment, in terms of delivering numbers that economists did not expect. And markets responded accordingly. Stocks were up strongly. Bonds stabilized. Rates did not go down, but at least they leveled off. And that's how we looked at the start of the third quarter of 2023. Now, going into the third quarter, though, we knew the uncertainty still prevailed. And during the third quarter, we noticed what I would think of as a bifurcated market. The first 6 weeks of the third quarter were good. In July and the first half of August, markets continued their march upwards, and the consensus view that seemed to be forming then was that we'd evaded a recession, that we were in for a soft landing and that recession would come down. And something happened in the middle of August. I'm not sure what, but the mood shifted, and the second half of the third quarter has proved much more negative. So as we head into the fourth quarter, let's take a look at what the third quarter delivered and perhaps even take a look at the entire year so far. Let's start with interest rates. Looking at treasury rates across the term structure, the year has essentially been running in place with two big differences. One is in the first half of the year, long-term rates were stable. They stayed at pretty much where they were, and short-term rates shot up. In the third quarter, the reverse happened. It was long-term rates, the 10-year and 30-year rate, if you look at what happened in the third quarter, were up strongly, but short-term rates were stable. So treasury rates have not done much, but there's been a shift in long-term versus short-term rates. The fact that long-term rates went up in the third quarter and short-term rates stayed where they were meant that the yield curve, which has been downward sloping for the last year, became a little less downward sloping. Read into it whatever you want. I don't believe that the yield curve is some uncanny predictor of what's going to happen to the economy, but it did become less downward sloping. Now, moving on to stocks, I've plotted out three indices here: the S&P 500, the Nasdaq, and the S&P 600, which is a small cap index. If you look at the entire year, here's what you see. The S&P 500 and the Nasdaq are still up strongly, but they gave up some of the gains they got in the first half of the year in the third quarter. The S&P 600 was up for the first half of the year, but it's given up almost all of those gains by the time you get to the end of the third quarter. It's pretty much flat for the year. That shows you that this has been an uneven market. Small cap stocks have clearly not benefited as much as large cap stocks, and even among large cap stocks, the gains have not been widespread. In fact, 7 companies account for the bulk of the gains in the Nasdaq and the S&P 500. Here are the 7. Five of them are from the FANGAM grouping that I've tracked for a while: Apple, Microsoft, Facebook, Google, and Amazon. The other 2 are NVIDIA and Tesla. You take those 7 stocks out of the mix, it's been a pretty flat year for stocks overall. It's been a concentrated market with those 7 stocks carrying the market upwards. Now, moving on to looking at sectors, you see the same issues come through. If you look across sectors, and this is globally across all sectors, and these are the S&P 500 breakdown, 5 of the 11 sectors are down for the year. So again, it shows you how the market has been uneven. Of the 6 sectors that are up, the strongest has been technology. And as I said, it's not all tech stocks, it's large tech, and a small subset of large tech stocks that's carried that forward. The next best has been communication services, followed by consumer discretionary. The worst sector in the market have been 2 sectors: real estate and utilities, which have been down strongly, and we can talk about why, but clearly those are the 2 worst affected sectors. When you look at stocks broken down by region, the best performing region in the world is India. It's up 11.75% for the year, and it's the only part of the world which had positive returns, and these are all in US dollar terms in the third quarter. The US had a down quarter in the third quarter, but it's still up 10.32%. The worst performing region in the world is Latin America and the Caribbean, down 11.2% for the year and 15.9% in US dollar terms just in the third quarter. Again, you can see the variation across regions in terms of performance of stocks. Now, one of the numbers that I track because I find it useful to get a sense of where the market is going is the price of risk. The price of risk is what investors are demanding to take risk in different markets. So as people get scared, they demand a higher price. As they get more comfortable, the price of risk drops off. Just to lead into this year, the price of risk rose strongly in 2022 in every market. In the bond market, this showed up as default spreads going up significantly in 2022. If you track what default spreads have done in 2023, the answer is not much. Especially at the higher ratings classes, the default spreads are pretty much where they were at the end of 2022. The lowest rated bonds, though, the riskiest bonds, have seen default spreads drop in a fairly significant way. So the price of risk has decreased in the bond market, at least for the lowest ratings classes, not so much for the higher ratings classes. If you look at the price of risk in the equity market, this is a number that I estimate at the start of every month. I call it an implied equity risk premium, where I back it out of what stock prices are. So this is for the S&P 500. And if you look at the equity risk premium over the course of this year, it's decreased. It started the year at about 5.94%, which in turn was significantly higher than what was at the start of 2022. So 2022 was a year when fear won out, risk premiums went up. During the course of the year, equity risk premiums have leveled off. If you look at the start of July, it was 5%. Start of October, it's 4.84%. The equity risk premium itself has been relatively stable, just as in the bond market, default spreads have been relatively stable. But because the T-bond rate went up, the expected return on stocks, which started the year at 9.82% and dropped to 8.81% at the start of 2023, is back up to 9.42%. So essentially, you can see that investors are pricing stocks to close to 9%. And you can see that over the course of the third quarter, the expected return on stocks is up. But almost all of that is being driven by the rise in the T-bond rate, not by rises in the equity risk premium. So the price of risk, at least in 2023, has been relatively stable, suggesting that there's a storyline here. It's not a fear storyline. It must be something else. Now, one of the issues I highlighted in 2022 was how risk capital had fled the market. Now, just again, to set this in perspective, we came off a decade where risk capital was not just abundant, it was excessive. And it showed up in young companies getting as much funding as they wanted, and essentially a rise in the price of the riskiest assets, young money-losing stocks, high-yield bonds. And in 2022, we saw a reversal. The middle of 2022, you could see risk capital leave the market. And it's one of the questions I had was, is risk capital coming back into the market? So I'm going to use three metrics for how much risk capital there is in the market. The first is the number of IPOs. If you look at 2021, it was an all-time high in terms of number of IPOs and the proceeds from IPOs. 2022, especially in the second half, you saw a dramatic drop-off in both the number and proceeds. And that's not come back. I know that in the third quarter, you saw companies start to tiptoe back into markets. And especially in September, you saw some high-profile IPOs. I wrote about Instacart a few weeks ago, and I've talked about ARM, which is the AI company. And there have been a couple of other, but it's still not a jump in IPOs. If you look at the number of IPOs in the third quarter, it's better than it was in the first and second quarters, but it's more risk capital tiptoeing back into the market. It's worth noting that the IPOs that went public with a great deal of publicity in the last month have struggled to preserve their IPO prices. Another sign of risk capital is IPOs go public and they keep going up. You haven't seen that in 2023. So at least on an IPO metric, risk capital is not quite back. It might be tiptoeing back, but that's all you can tell. Another measure I use for risk capital is how much VC investing there is in companies. So here I'm tracking VC investment in companies, in private companies, broken down into startups, early stage and late stage. And here again, you can see the drop off in the second half of 2022. And here again, you can see that the money has not come back. Unfortunately, I don't have the third quarter numbers for VC yet, but at least in the second quarter, you saw the drop off from 2022 carrying forward. And I have the numbers at least for July and August, and VC didn't come roaring back in 2023, in the third quarter of 2023. So here again, you're seeing risk capital tiptoe back into markets rather than come roaring back into markets. The third metric I'm going to use for risk capital is original issuances of high yield bonds. These are companies with below investment grade ratings that issue bonds directly to markets. Now, for these bonds to get acceptance, you need risk capital because they're the investors who buy these bonds. If you look at what's happened in 2022 and 2023, you can see that issuance has dropped off fairly significantly from where it was in 2021. There is some good news in this graph. If you look at bond issuances in the second quarter of 2023, you can see overall bond issuances are up, even though rates are higher. And that's good news. But the portion of that's high yield is still remained low. So here again, I think you're finding the same story you found with IPOs and venture capital. So if I have to sum up, it doesn't look like risk capital that left the markets in 2022 is back. And I'll be quite honest, I don't think it's going to come back to 2021 levels because those levels were unhealthy. So I do think that we're going to see risk capital start to come back into markets, but come back cautiously. And that's what the metrics are suggesting so far. So don't expect a surge in IPOs and a sudden jump in offering prices, because I don't think that's going to happen until risk capital is healthier. Finally, let's take a look at the economy. Now, if you look at macro concerns coming into the year, the question at the start of the year, as I said, was not whether the economy would go into recession, but how quickly the recession would kick in and how deep it would be. Well, the economy has surprised us. If you look at the statistics of the economy on the unemployment level, there's almost no signs of a weakening economy, either in the unemployment rate or in unemployment claims, which, even though they're elevated from last year, are not at levels you'd expect during a recession. If there's any sign of weakening, it's only that the economy is not as strong as it was last year. But if you look at actual signs of a recession, they're tough to find. And that's starting to permeate into what economists think will happen to the economy. Remember, I said at the start of this year, there seemed to be a consensus view that there'd be a recession. This is actually the percentage of economists who were surveyed who thought there'd be a recession. Now, it's a Reuters survey. At the start of the year, it's about 65%. At the end of the third quarter, that number is down to 40%. I think this tells you how much economists follow the data rather than lead the data, perhaps making you a little more cautious about taking their forecasts at face value. You think, what about inflation? For the first half of the year, we got good news on inflation. The consumer price index came down, so did the producer price index, and expectations of inflation, both in surveys. There's the University of Michigan survey of consumers, and in the US Treasury market, where I take the difference between the T-bond rate and the TIPS rate, all decreased fairly significantly in the first half of the year. In the third quarter, we stalled. We didn't get bad news on inflation, but we didn't get a continued drop in inflation. In fact, there's been a little bit of an uptick in expectations of inflation going forward. That bears watching, but I think we're ready now to do what? To actually value the market. This is something I do reluctantly because market timing is not something I do, not because I don't think it works for other people, but it doesn't work for me. I'm not very good at it, but I'm going to try anyway. To value the S&P 500, which is what I'm going to do here, here's what I need. I need to project out expected earnings and the cash flows you will get from those earnings. And remember, cash flows on US stocks take two forms, dividends and buybacks. Second, I need to discount those cash flows back at a required return on stocks. Well, you're saying, what does that mean? It contains two components. One is a risk-free rate, a T-bond rate as a base, and the second is an equity risk premium for stocks collectively. In this picture, you see my valuation of the S&P 500 on October 1st of 2023. But it's really not my valuation. Think of it as a consensus valuation of the S&P 500 where I'm using market estimates for earnings and growth rates and risk-free rates. For the earnings numbers, therefore, I use the consensus estimates of earnings from analysts tracking the index for 2023, 2024, and 2025. You're saying, now, why are you stopping at 2025? That's all I could find. Beyond 2025, I use an expected growth rate of 4.58%. You're saying that sounds oddly precise. That's actually the risk-free rate. I'm assuming the growth rate in earnings will converge on the risk-free rate because in the long term, the risk-free rate becomes a fairly reasonable proxy for nominal growth in the economy. So that gives me my expected earnings. To get my cash flows, I start with the percentage of earnings that were paid out as cash flows in the most recent year, which is 2022. And then I adjust that payout ratio for the fact that to sustain the growth rates that I have in years 4 and 5 and beyond, I need to be reinvesting some of those earnings. So what you see as my payout ratio reflects those expectations. To get my required return, again, I go with the market. What does that mean? I make no judgments in the T-bond rate. I know there are some of you who think it's too high and some would think it's too low. But for this analysis, let's assume that 4.58% is steady state. This is where T-bond rates will be for the foreseeable future. The equity risk premium, I settle in on a 5% equity risk premium, which is roughly what we've earned since 2008 as an equity risk premium for stocks. So 4.58% plus 5% gives me an expected return on stocks of 9.58%. So this isn't rocket science. I discount my cash flows back at 9.58%. Notice that my year 1, 2023 cash flow is only 1/4 of a year away. So the discounting reflects that. And I get a present value of 41.47. You're saying, what does that mean? At least based on consensus views on earnings and cash flows and this market perspective on rates, I get a value which is pretty close, 3.4% below the actual index value. Now, if you believe this intrinsic valuation, stocks are very, very mildly overvalued. In fact, you could argue they're closer to fairly valued than overvalued. Now, of course, you can disagree with this. And this valuation is a bit of a cop-out since I'm taking market views on earnings and the T-bond rate is a given. And I am sure that you will disagree with me on this valuation. And there are two ways you can go. The first is if you believe that inflation is going to reappear, that it's just, genie's out of the bottle, then you're also assuming that T-bond rates will continue to rise, not just to 5, perhaps even to 6%. If you believe that, then clearly you're going to find stocks to be more overvalued than I do. The second is you might also believe that what we have is a slow motion recession, that this recession that people have been predicting is going to hit us. It's going to be a lot more severe than we think it's going to be, which is going to show up as a hit on earnings. Those expected earnings that analysts are projecting are too high. If you believe that, then again, you believe that stocks. So those are the two scenarios where you believe stocks are going to be more overvalued than I do. Now, conversely, you might also believe that rates are going to come back down, that inflation is in fact much lower than the actual numbers indicate, which is going to push down T-bond rates over time, and that the economy will skate by without going into recession. If that's the case, then you might actually conclude that stocks are undervalued at where they are now, rather than overvalued. Now, having conceded both of those, as I said, I'm not a market timer, but I am uncertain about the numbers. I agree with you. The T-bond rate could change. The equity risk premium could be very different. Earnings could drop. They could rise. And I fell back on a tool that I've used before, which is a Monte Carlo simulation. And here you see my Monte Carlo simulation of the entire index. I've allowed the risk-free rate to vary from a low of 3.58 to a high of 5.58% with a base case of the existing risk-free rate. For the equity risk premium, I used the expected value of 5%, but allowed for the fact that it could be as low as 4, as perhaps even reach as high as 6, 6.5, if a crisis hits. And on earnings, I concede that analysts could be wrong in both directions. They could be overshooting or undershooting earnings depending on your perspective on a recession. Now, allowing for that variation in my inputs, I get my estimated index value. You can see the distribution. And you can see my median values for the index is about 4,200. Again, suggesting that stocks are very mildly overvalued. But there's also, if you're investing in stocks, there is a disquieting component to this table. You can see that the downside is more pronounced than the upside. And that might suggest to you why investors are staying out of equities. At least it's not that they think that stocks are overvalued, but they think it's asymmetric in terms of payoffs going forward. There's much more downside than upside. So what do we do now? If it feels a little bit like Groundhog Day, it is Groundhog Day because the two big uncertainties at the start of the year were about inflation and the economy. And it's amazing how little we have learned about either of those uncertainties over the last 9 months. I think we're almost in the same position we were in the start of the year. The two big questions that we face, just as at the start of the year, were what's going to happen to inflation over the next quarter, the next year, and will the economy go into recession over the next quarter and the next year? I expect those uncertainties to continue, and that's going to mean more ups and downs with this market. You're going to get the mood swings we've seen for the course of the year, where consensus forms either on one side or the other. Right now, the consensus seems to be negative, but you can see how quickly it can change. Also, if you are somebody who's selling short on the market because you think it's massively overvalued, at least be honest about what's driving your decision. It's not because you're afraid of the Fed or because you think the PE ratio is high. It's because you believe there's bad news about inflation in the economy that the market is not facing up to. And that's perfectly okay. I hope you found this session useful, and thank you very much for listening. Take care.